Okay, so how do you ensure that a property or an apartment complex like this is going to be as successful as it can possibly be? Well, number one, make sure that you try to get as long-term fixed debt as you can possibly get. When it comes to apartment complexes, whereas with residential, long-term fixed rate debt. And so when it comes to the balloons and the adjustable rate mortgages, you want to try to make that term as long as you possibly can. In most cases, your options are going to be a 3-year or a 5-year. And if you're lucky, some commercial banks offer a 10-year loan. I would really lean towards that 5-year and that 10-year. And then you really want to stress test that deal, because after those 5 years, whatever the interest rate is at that time, your rate, once you refinance, is going to adjust to that new interest rate. And so to protect yourself from that, if you're running the numbers at a 6% interest rate or a 7% interest rate in today's market, it would be very prudent of you to run the numbers at 8 or 9% in case those interest rates increase over time. The other thing that I would highly recommend you do is to have ample reserves and liquidity in your operating account. You don't want to plan on renovating your unit with cash flow. That never works. I have tried it. I failed miserably. You want to make sure that your cash flow is in one bucket, but that you have cash, liquid cash, sitting in a bucket for a rainy day, or if your construction goes over budget, that's just sitting there so that you could weather a storm. And it's also sitting there in case you run into what a lot of multifamily investors are running into today, where their interest rates have increased, and thus their cap rates have increased, and thus their values have decreased, and they have to come to the closing table with a lot of cash in order to save that deal. Because remember, in real estate, if you can hold on to that real estate, you will win. Real estate is a very forgiving business if it's held on to long term. And so the people who don't have that liquidity and reserves and are forced to either sell or refinance that property at a loss, those are the people who ultimately lose in this business. So if you have that longer term for your debt and you have those reserves, and then thirdly, I would say invest for cash flow. So do not invest for appreciation. Ironically, you make more money in real estate through appreciation than anything else. For me personally, I've been in this business for 8 years, and from the time I started to about 6 years from that, I got very lucky. The COVID era took place during that time. Interest rates were extremely low, and property values went through the roof. And so I made a lot of money during that time because I sold some properties, refinanced others, and I had these huge lump sums of cash that allowed me to make other moves in real estate, including paying off my house and buying more investment properties and things like that. And so appreciation is where you make the most money. But if you underwrite and you invest for appreciation, you are going to get into trouble, because the only way that you could survive through ups and downs in the market is through cash flow. If you find yourself upside down monthly on a mortgage, you're going to get into trouble. Whereas if your deal is constantly producing income, you will be able to weather storms. I look at cash flow more as a safety margin. If a bunch of things go wrong, how much margin do I have until I have to come out of pocket? And if things go really wrong, can I weather that storm through the income of the property, or do I need to dig into those reserves? And so on the other hand, the people who just, underwrite for appreciation, don't have any reserves, don't stress test their deal, don't do, as long of a term as they can, those are the operators who get into trouble. If you do want longer term fixed rate debt with multifamily, there is the option of agency debt, which is Fannie and Freddie debt. In those terms, you could get 30-year amortizations rather than 20 years, and you could get 10-year fixed rate debt rather than 3 to 5 year. And then there's also some interest-only options to help you, increase those rents or improve your cash flow for a short period of time while you stabilize, and then it goes to principal and interest. So there are those options. And then if you do residential, I always highly recommend trying to get as much 30-year fixed rate debt as humanly possible. the people who get 30-year fixed rate debt, especially if you buy real estate below the median, if you're in an affordable market, you're investing for cash flow, and you get that 30-year fixed rate debt, it's very difficult to get into trouble assuming that you have some cushion or some reserves in the bank. Very difficult, because regardless of interest rates, regardless of the economy, regardless of what the president does, you're not going to lose your property so long as it's cash flowing and you can pay your monthly mortgage.